Talk to me first about your outlook for U.S. equities, because I understand you're looking at 11% upside for the S&P. What is your best and worst case for corporate earnings this year?
I think the way to think about it, and the conversations we've been having with portfolio managers here at the conference, is the idea of the S&P 500 index rising to around 6,500, which would be around 11% gain from the current level. The way to think about that is earnings per share likely to grow around 11% in calendar 2025 and about 7% in calendar 2026. So equity investors are already thinking about not just the current year, but looking into the next year. Specific to this conference, we've been focusing a lot of questions around the fourth quarter earnings season that is about to kick off today. And so from earnings growth for this quarter, reporting is around 8% gain. And one of the big questions has been, what's the impact of a strong dollar? The strong dollar that really was notable in the fourth quarter would suggest that the magnitude of surprises in the reporting season are likely to be somewhat less than you've seen in the last, say, couple of years. Typically, you get a earnings season where the positive surprises are around 400 basis points. So if that was the case, you'd have earnings growth something closer to 12%. I think that's not likely to be the situation this quarter, probably a little bit less. Some positive surprises, but not so much. So we think about the general trajectory of the U.S. equity market. Earnings are the driver, not multiple expansion. The U.S. stock market trades around 23 times, 22 to 23 times forward earnings. That's a very high multiple, historically speaking. So it's really earnings that are going to get us to our target of 6,500.
Okay, so you talk about dollar strength, but we also have very elevated yields right now. Obviously, we're waiting for inflation data. Do you think we're at the peak of yields, and to what extent is that going to be a headwind for equities?
Well, a higher bond yield environment is a concern. It's a concern for a couple of reasons. One, the speed with which bond yields have backed up. Both real and nominal yields have gone up almost 50 basis points in 1 month period, which is a very swift and high magnitude of movement in a short period of time. And historically speaking, that's been a headwind for equities. And in fact, equities in the last month have sold off slightly here in the United States. So the idea of a higher bond yield environment would be a headwind for really strong returns. Our expectation is that inflation is coming down slowly, and that bond yields will fall over the rest of this year, something closer to 4.25% on nominal yields, down from the current level, which is much higher than that. So I'd say that's a big area of focus for fund managers. One of the questions we spent a lot of time with yesterday on the first day of the conference.
But there's also inflationary pressures from possible Trump tariffs, right? And I'm also curious, what do you think is the risk for those mega caps with huge revenue exposures to China, for example, Tesla, Apple? Already we've seen NVIDIA in the crosshairs as well. So
it's a definite question we're receiving here, and not just here among conference attendees in our Hong Kong conference, but also from our colleagues and clients in the United States. So the way I think about it is that it's Trump is somewhat mercurial in terms of the actual tariffs that may or may not be imposed, how much, at what pace those might be implemented. Those are questions that remain to be decided. And so as a portfolio manager, the way we think about it as strategy is thinking about owning U.S. companies whose primary revenues are domestically driven in terms of the United States, and avoiding or selling those companies whose primarily sales are coming out of the country. And the intuition behind that is that companies with high degree of domestic sales won't have the immediate risk of higher retaliatory tariffs. The retaliatory tariffs are likely to be imposed on companies that are more export-oriented. So that's a risk, if you will, to those potential earnings for those companies. So that's the way we think about that. That trade has basically, I think the opportunity still exists to be owning companies that sell domestically and basically selling companies that are more internationally exposed. That's one of the risks around the so-called Magnificent Seven companies. Around 50% of their sales actually take place outside the country, outside the United States. So that's one source of potential risk. Now, we think about these big companies and the source of excess return. There have been fantastic stock performance in calendar 2023 and calendar 2024. Those were associated with premium earnings growth. That premium growth is likely to narrow pretty substantially. There's some numbers around that. If you look at 2024, and of course the fourth quarter results still yet to be reported, but their earnings growth was 30 percentage points greater than the rest of the market. That's likely to narrow to something like 7 percentage points premium in 2025 and 3 percentage points of premium in 2026. So that narrowing premium earnings growth is likely to result in a narrowing excess return. Still outperforming in the coming year, but by a relatively small amount. And that's one of the reasons why, when we think about the best investment trade out there right now, has been focusing on mid-cap stocks. Mid-cap U.S. equities, somewhere between $5 billion and $20 billion U.S. in size. That's an area of the market that has outperformed long-term. They trade at much lower multiples than the rest of the market, probably 16 times forward earnings relative to 22 or 23 times for the large cap stocks. Similar kind of growth rates. That's a much better risk reward in my opinion.
So you favor the mid caps, and the next 7 still have some room to run. I'm curious, do you see any interest from U.S. investors to reallocate to China? And if not, what would it take to see more rotation back to China?
We have not seen a lot of interest in terms of my conversations. To be fair, my focus is primarily on the U.S. equity market, but when talking to U.S. companies, U.S. investors, the question is more about, can they get perhaps China access via U.S. equities if they had to do so, as opposed to owning the actual U.S. Chinese companies. That's the questions that I'm receiving.